Stand. Sailesh Bhan now joins us. Sailesh, good morning. Thank you for joining us. Sailesh, I guess my comment could be a question in itself, which is that normally markets, they follow a style. Either it is growth, either it's value, either it is dividend, either it is technology. Right now, you got excitement in the value end, which is steel, metal, cement, and you got euphoria in the extreme high-end market, which is an info edge or a trend or a jubilant, or for that matter anything which has got to do with tech.
See, Nikunj, like you rightly said, markets are trying to find new winners and new categories. Like you said, the deep value category, it's no longer value, metals or, public sector stocks or the old economy business are no longer value. They're actually deep value because they've done nothing for the last 8-10 years. So markets are vacillating between these two pockets where, growth at any price at one level and, low growth at very reasonable valuations at the other level. And as we continue to remain in this environment, in fact, over the last 2 months or 3 months, you've seen value significantly outperforming growth at any price. So I think that shift, the market is trying to navigate that shift and which is starting to get visible. In fact, last 1 month was a substantial outperformance of value over pure growth at any price.
Sailesh, you track pharma with a magnifying glass, not a magnifying glass, but with almost like a microscope. You have a very deep understanding of Indian pharma, global pharma, MNC pharma. What is happening to pharma as a cycle? I spoke to the management of Cipla, and when I asked him that how has life changed for you because of COVID, he says, nah, it's just a little bit of tinkering here or there, some margin saving, but it's not like because of COVID, we've hit some kind of a gold mine. So if that is not the case, then why are markets so excited about buying pharma stocks?
See, pharma for the last, other than the last, say, 6 months, prior to that, it was struggling for a 3 to 4 year period, right? And we have seen earnings improving for the last 12, 18 months, but markets were not responding to it because markets had become extremely narrow and only a select set of stocks and business were doing well. The earnings cycle for pharma is certainly on an uptrend from the low base of, say, 2018 and 2019. And very few sectors today offer this visibility of doubling earnings in a 4 to 5 year period. So that's one. Second is valuations of these businesses were 30, 40, 50, and even 60% cheaper than consumer businesses. Some part of pharma businesses do have characteristics of the consumer space. So I think that correction actually also happened in terms of the re-rating, which was visible to us. More interestingly, I think, like I said, the narrowness of the market is slowly broad basing. You saw pharmaceutical sector participating. Now you're seeing metals starting to participate. You'll see possibly some other sectors, utilities, which is a forgotten sector in India, starting to participate. And maybe if some good news comes in public sector businesses, you'll have public sector and engineering business starting to perform. So it's more a function of a gap of earnings was there in sector for the last 4 years. That I think has clearly turned because most businesses are now talking about earnings doubling in a 4 to 5 year period in pharma. And valuations, at least what they were about 3-4 months back, were absolutely mouthwatering in that particular space. And that actually is derived or led to the significant change. Also, the weightages in the indices were, ignorable, about 3% weight in the index. People said we may avoid pharmaceuticals because we don't understand the FDA challenges and all that. But I think when you have an outlook which has improved materially, not because of COVID, but because of their own business cycle turning, I think participation also improved materially. So I think such kind of a thing which has happened in pharma should be visible in several other sectors over the next 12, 18 months is my opinion.
So we'll just put your declared portfolio out, public information. You own pharma. Can I safely assume that your view on pharma for next couple of years is constructive and you think it's a secular bull run we are in?
Clearly, I think it's an earning revival underway for the sector. Earnings will only get better from where we stand, and that will support at least earnings-led growth for businesses in this sector. So I think that is what is the visibility today. And directionally, the worst of bad news, if you look at it, pharma was through a perfect storm. The perfect storm has now ended, and you're actually in a reasonably positive operating environment. So we are positive on the sector from an earnings point of view, and a re-rating element I think is already over for the sector at the moment. So it's only earning-led returns which shareholders should expect in the pharmaceutical space over the next 3-4 years.
Portfolio out, public information. You own Pharma. Can I safely assume?
Okay. Sailesh, you were just highlighting that there is renewed optimism in metals. And sure enough, I think the big thing that's also working in their favor is that most investors are still underweight the space. And maybe that's why there's going to be a bigger catch-up, which is going to be in place. Where within metals, again, would you find optimism? Is it the iron ore space? Is it steel? Or would you say that a blanket bullish call on metals will also work for investors right now?
See, metals generally are coming out of a very, very difficult cycle. 8-10 years, this is again one of those forgotten sectors. They never really delivered over the last several years. And valuations across the board are actually way, way below replacement value, way below, the cash flows they are generating, even in difficult times. Some businesses had challenges because they were over-levered also. So, rightfully so, they've been battered by the market. When you see a shift where you believe prices are going to get better, the profitability of those businesses changes materially in metals case. And we think it is broad-based because you've seen all asset prices virtually rise because of lower excess liquidity in the system, plus normalization of global demand and lack of any new capacity creation in the last 5-10 years. I don't think larger capacity creation has happened in metals globally over the last several years because of people avoiding the sector because of the excess capacity which existed. So when you see normalization in some of these sectors, it lasts very long. And more so, the today's valuations don't reflect any large or any major uptick in earnings in this sector. Ideally, margin expansion for this sector, especially when excess capacity moves out, can be way bigger than all of us can understand today. And the weights in the sector today in indices are negligible. In fact, I think less than 2% would be the weight in any large index for a metal sector weight in the any large index today.
Sure. Sailesh, what's the reason for the underperformance within financials? And would you say that the interest waiver as well as the moratorium case is a big overhang right now?
It clearly is, because for the first time we have seen a 6-month moratorium. I don't recollect this long a moratorium in any environment. And a 6 month is a very long period for not collecting or, not receiving money from customers. Secondly, we still don't know the full phase of economic recovery. The festive season might be decent because we have a very low base over the last 4-5 months, and then you have inventory creation for the festive season. But what happens post the festive season in Jan, Feb, March is also an important factor to look out for. Second, if you see, prior to this, we have had a huge retail boom in India. In fact, retail lending actually was possibly doubled in a 4-5 year period in the last 5 years. And I think on the back of reasonably high retail leverage in the system, you are getting into a slowdown which is pretty sharp and pretty deep. So there certainly are challenges for the banking sector. And however, we believe the larger banks are far better placed because they have raised capital. They are well positioned to handle this kind of a problem. But broadly, for the overall financial sector, yes, certainly it doesn't seem to be out of the woods yet. We will really know actual data coming out when companies comment in the next 1.5 months in terms of how the moratorium has ended and how people are behaving. As also the fact that by January, February, we will really know the non-performing asset data from the COVID impacted sectors.
Sailesh, do you think this is the right time then to get into damaged sectors like hotels, travel, multiplexes, for example? Given the outlook or the recovery timeline one's looking at and risk perception now gradually receding, would this be the right time, or would you still remain cautious?
The COVID damaged sectors today trade at bankruptcy valuations. They're way below book, way below replacement value. And it is unlikely that these sectors don't normalize over a 12-18-month period. Anybody's guess, but I think directionally within a 12-18-month period, a way better operating environment is possible for these sectors. In fact, airlines are already working at 30-35% of capacity utilization. So it's starting to happen, and or 35% of the levels they were pre-COVID. So when you look at these particular spaces, valuations there are completely in distress, and these are companies which will survive this particular crisis because these are generally the leaders who have survived till now and have remained debt light. Also, I don't see any new capacity in these sectors for the next 3 to 5 years. I don't think any bank will have the courage to lend to these sectors beyond just retaining this asset. So virtually there'll be no new capacity creation for a 3 to 5 year period. Generally, these are long gestation projects, so it takes that much of time. And second, with no new capacity coming in and a huge pent-up demand under play, on normalization, I think we should well be in a bull market for these COVID damaged sectors in a 1 to 3 year period. So that seems to be a high possibility. Buying leaders or investing in leaders in these categories, I think the risk reward is disproportionately in favor.
Okay, great. What about the underrated or under-owned sectors also, as you define them? Engineering, power, we continue to see some reforms. So would the outlook be upbeat there on some of these names?
See, power, I think, is coming back very, very strongly. In fact, if the reforms which are being talked about are implemented, it could well be a significant improvement from where we stand for that sector. Also, power or engineering and these sectors have significant, the lower interest rate environment directionally benefits them a lot. In fact, replacement capex starts happening. You have a lot of such things which can come about. Also, we have this manufacturing low tax rate at 15% for setting up new capacities by FY23. This will actually create significant demand for the manufacturing side of it. Then you would have the challenges which are coming about with the US-China trade issues which are there, which are shifting or which are allowing other companies to look at India as an important source. That can also kickstart manufacturing activity in India. More importantly, we will also possibly see domestic demand because people want or shy away from importing a lot. A significant amount of import substitution supported by all government policies seems to be a direction today. So if you ask me, these damaged sectors could well be the sectors of the next 3, 4, 5 years. And materially so, they represent very small pockets of today's market capitalization, which means if larger amounts of money wants to chase these particular sectors because growth shifts there. It's a function of growth shifting to these sectors, and I think in all probability, growth will shift to these sectors over the next 1 to 2 years. And that will lead to possibly a significant outperformance of these sectors over a period of time. So all sectors, in index representation, these sectors virtually don't exist. The whole EPC space in India has about under 3% representation in any large index today. Metals under 2 to 3%. Engineering, they have very, very little representation in the space. So all of public sector utility businesses, power virtually has no representation. The largest of the largest companies, utilities have about 0.5, 0.7% weight in indices. So I think these pockets offer tremendous value in an environment which is where, at one level you have got growth at any price, and another level there is disproportionate deep value, like initially it was mentioned in this conversation. So I think significant deep value opportunities in these areas, and possibly a big re-rating for these sectors possible over the next 1 to 3 years as earnings in these sectors shifts. So every single pointer to that shift in earnings is visible today. And as COVID stress eases, I think these are the sectors to be watch out for.
That's a great point, Sailesh. But if I could just come back with another counter argument, which is that there is this whole ESG angle. There is a government dependence on some of these sectors. We know that the cash flows in government are so low that all the so-called road, bridge, and the other EPC contracts will not be rewarded. So while we can say that the representation is actually low in some of the stocks, the representation has been low for a long period of time.
See, it's a very valid point that the representation has been low for a long period of time, and it's been an elongated cycle. See, we must understand that the longer the cycle takes to turn, the bigger the possibility of a revival in those spaces. Now, this has been the norm. See, pharma also was a similar sector. 6 months back, nobody wanted to own it because it was not moving. 6 months later, everybody wants to own it because it is moving. I think there is beyond that people are putting a fundamental spin to it. The fact of the matter is pharma was as attractive 6 months back as it is today. If you see shift in earnings in these sectors, and these sectors starting to perform because of a fundamental change. Like you said, today government finances may not be in the best of shape, right? But you could look at reverse. We are virtually at only at replacement cycle demand for now 4 or 5 years, right? And you never had a manufacturing tax rate at 15%. If you set up a new capacity, your tax rate is only 15% if you do it before FY23. You never had a support or PLI kind of link support for a lot of sectors. You never had this US-China related tussle which is on. You never had companies wanting to shift or create capacities in India for local demand. Import substitution was never such a large or a big theme in India. Interest rates were never this low. Power availability has never been this high. So we can have different issues at different points of time. But I think we think a lot of things are happening much better in the manufacturing space today than they ever were. And if ever there is a chance for manufacturing to come back to India, it is now.
So for a fund manager right now, Sailesh, you have a compulsion to hug and beat the index. The index is very skewed in favor of financials. How would you take the risk of maintaining your compulsion to beat the benchmark, yet start looking outside the comfort zone? What I'm trying to understand is that how much should we expect radical changes in your portfolio, given that your thought process is alluding to a view where you are referring to a change in cycle and a change in trend?
Directionally, we continue to look at opportunities outside the index. So it's like, it's the classic battle between indexing and investing. And I think at different points of time, these markets switch. It's been an indexing market for the last 3-4 years because broader markets and economy is not performing. If we get greater confidence in terms of direction or broad basing of markets, in fact, last 1 or 2 months have been surprisingly differentiated returns for portfolios which are different from the market. So I think if we see greater evidence for that, we think this kind of a shift will happen. Also, investors, when you look at it, there are large sums of liquidity to be invested. People have put a 30-35% investment in financials or a larger share there. But if they want to own even 10-15% of their portfolios to larger industrial, engineering, domestic demand-driven businesses, I think the swing in prices can be way material. I think what's visible in pharma is likely to happen in some of these sectors. Maybe it'll take some time. Maybe it's a question of how long it will take. So for us, it's always within banking, for example, we would own the largest and the best capitalized banks and maybe underweight in NBFCs, underweight in other areas. And that underweight, we actually move towards the sectors which we think would be emerging from the next 1 to 5 year point of view.
Sure. Sailesh, great to have you on the show. Thanks so much for taking the time out and speaking with us today.